In this week's update, will the truce change anything? Not a bubble, it's justifiable growth. And gold and silver, dead cat bounce or sustainable ongoing trend? My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. All right, fascinating week, lots of market volatility. I guess the biggest news of the week was a truce of some sort between America and the US on trade, and the market reacted fairly sharply and negatively. Parts of the market did anyway. So I just want to examine whether that's warranted or not, and really following on from the last couple of weeks where I've been discussing whether AI is a bubble, as everybody seems to think it is, or is it an opportunity of a lifetime? So as far as the week that's just gone, it's geopolitics. So therefore, it's totally unpredictable. So I don't think you want to be drawing any conclusions from what happened earlier in the week with China and America, because the odds are it's not likely to stick. Things will change, it'll play out, even if it does remain, and they remain sort of friends for the next 12 months. You just have no idea how that's going to play out. And when it comes to the market, one of the best approaches is to continue with what is, the trends that are existing in place, and not try and factor in something that hasn't happened yet. So I think the probabilities are that this truce, as far as investors go, is largely meaningless. Now, I'm not saying that it won't achieve an outcome, but as far as its impact on what we're doing in the market, I don't think it's going to be very much at all. The reason that I say that, and again, this is pretty obvious and you've probably read it elsewhere, is the West has finally woken up after decades of allowing itself to get so far behind. The West has finally woken up, and the stakes are really, really high, because this is not just about trade and tariffs. This is very much about world leadership. This is very much about national security and way of life, even. I mean, it really is that substantial. And if you haven't realised that yet, then you better read a bit more widely, because that is really the stakes that are on offer here. Now, the consequences of this are that the development of critical minerals supply chains outside of China have to continue, and I think will continue, because the West has woken up to what they've been doing over the last 3 or 4 decades with allowing manufacturing to move out of the US and all sorts of other things. So the very abrupt market reaction where critical metals stocks got slammed, supposedly because the prices would come down, is just not realistic. It really isn't. Secondly, the race for leadership in artificial intelligence and quantum computing is going to continue, because that is all tied into world leadership and national security. And the tensions really won't disappear. So I struggle to see, even though there was an abrupt reaction from the market in certain parts, I struggle to see that it's going to have any meaning at all. And so therefore, this bit of short-term weakness we're seeing in some of the sectors, and also in semiconductors, is an opportunity. Now, the outlook, so where to for critical minerals, where to for semiconductors, where to for precious metals. My position at the moment is there is no change, and it will remain that way until there is actually some factual evidence that trends are changing. It's about, as far as critical minerals and semiconductors go, it's about the supply of raw materials, and it's also about the development of processing technologies, very advanced, world-leading processing technologies, and that is going to continue. And when it comes to precious metals, there has been a move away from the US dollar debasement trade, whatever you want to call it, and that's been underway for several years. That's not a recent event. And it's about the US debt, the incredible debt, $38 trillion that they're holding. It's about tariffs. It's about a lot of other countries just getting sick and tired of the US sanctions. So I can't see that that is going to change either, which is going to put downward pressure on the US dollar and therefore at least some upward pressure on commodity prices. So I don't really see that there's very much that has really changed for those three megatrend areas, and they're three of the 6 or so megatrend areas, which is really my sole focus. Let's not worry about the rest of the market, because the rest of the market can't provide what it is that I look for, which is high growth and high probability of that growth materializing. As always, we advise that before you act on anything in this video, that you seek other investment advice that you may need, be that financial, legal, or any other. All right, let's look at precious metals first. Gold slipped, was down $104 for the week to 4,004, but look, it had such an incredible run that this is actually a good thing. We didn't want gold continuing on because the ultimate correction would have been far more severe, and that then kind of rattles people's psychology, and it goes down further and it stays down further. So what we've seen in the last week is actually a good thing. When we translate that into Aussie dollars, it's still over $6,100. And given that most of the Australian producers are somewhere, their all-in sustaining costs are somewhere between about 2,200 and 2,700, it's an incredible profit margin. And we're seeing the enormous cash flows and cash build-ups with the Australian gold producers. Silver, 48.8, bounced off a support level that I showed last week. There was a big plunge on Monday, but it bounced quite nicely off that and actually did better than gold when we get to the charts. The US dollar was up a little bit, and there were also lower geopolitical concerns because of this supposed truce. We'll see where that goes. We know how unpredictable Donald Trump is. So take away that geopolitical risk premium, US dollar rising, and that was the impact on gold. It had to go down. Now, if we look at gold stocks, we saw a pretty nice bounce. Now, I'm not saying that it's now all over and the gold stocks are not going to have another leg to the downside. I'm not saying that at all. However, at the moment, on what we can see, it has been a short and sharp pullback. And if that is sustained, then that is a really good sign of the underlying buying strength in the market. Now, speaking with a few people of late, there is a bit of a sense of, well, if precious metals are going to do so well, let's just put a massive amount of our chips on the precious metals trade. I think it's unwise to bet the house in any environment on any particular sector or any particular stock, but particularly in a market that's as nervous as this, because reactions can be very sharp, as we saw during the week with the reaction to particularly the rare earths. So I certainly wouldn't be doing that. The focus needs to be on managing risk to suit your game plan. And if you don't have a game plan, then you really shouldn't be in the market, because it's just this kind of market these days. You're going to get your head handed to you on a plate if you don't have a very clear game plan. Let's go and look at some charts. So you can see we had a significant move down on Monday in silver. We had long tails on these candles on both Monday and Tuesday. So whilst there was a significant gap down, there was a lot of indecision. There was a lot of conflict of opinion in those markets for the candles to look as they do with these long wicks, top and bottom. And then the market quickly regathered itself and went up on both Wednesday and Thursday very strongly. Came off a little bit at the end of trading on Friday, but nevertheless, that's a pretty good bounce. We could still get another leg to the downside if any fundamentals change, but at this stage, this is looking pretty solid, and the long term is unchanged. Now, this is gold in American dollars. As you can see, the rebound not nearly as strong as we saw with silver. When you look at what had led into last week, so through the middle of October, the gold price had got very, very significantly away from this blue line here is the 50-day moving average. And if I had a 20-day moving average, you would see that it's even gone quite significantly above the 20-day moving average. So this was a parabolic move that had gone too far too fast. So inevitably, there was going to be some profit taking from this very overbought peak. And then we got some bearish sentiment kicked in, the prospect of better US trade relations. We'll see about that. And also the Fed hawkishness on future rates, Powell saying that there may not be another rate cut this year. So the difficulty for the Fed is that they've got a dual mandate. That dual mandate is whether they look after the labour market or whether they try and address inflation. To date, they've been more concerned about the labour market, which is why rates have come down. But inflation, whilst it's certainly a lot better than what we've got here in Australia, inflation is still not down to the level that they would like. And it wouldn't take much to turn it around and start to head back up again, particularly once the impact of these tariffs start to flow through. So they're kind of between a rock and a hard place, the Fed, because they can't really do both. Is the US relations with China, is it really better? I can't see that it is. The underlying factors, the disagreements, the desire for world leadership, they're all still there. Nothing has really changed by this 12-month stall on, particularly around critical metals and semiconductors. So the odds are that this is a healthy and welcome reset in the gold price. It's pulled it back probably to the 20-day moving average and allows that trend to be more sustainable. But it's too early to really claim that we've hit the bottom in the gold price. I would not be at all surprised, as I said last week, to see gold perhaps head down into the mid 3,000s. I think that would not be a surprise at all. So again, we come back to there are no certainties in the market. You've just got to manage risk, manage your weightings. Don't assume that anything is a given. And if you work from that basis, then you're going to be in pretty good shape. Now, if we look at the Australian dollar gold price, you can see very, very buoyant indeed. And we've managed to pull back to this peak line here is the 8-day moving average. So that is when we're bouncing off the 8-day moving average, that is a sign of incredible strength in the trend. Let's look at the impact on stocks. This is the GDX listed in Australia, but obviously includes global stocks. And it looks pretty similar to what we were showing there with the Australian dollar gold price. We've got a very significant bounce at the end of the week. So we sold down, we filled this gap. So technically that ticks that box. And then we've bounced very, very strongly. And if we look at GDXJ, which is the American listed ETF, it's a very similar situation. Dipped just a touch below the 8-week moving average, but still looking very, very strong. So that's the setup in the precious metals market. If we now turn to US stocks, the S&P was up 0.7% for the week, but the NASDAQ did far, far better thanks to the market reaction to Google, Amazon, and Apple. And the NASDAQ was up by 2.25%. However, the breadth did deteriorate quite dramatically because the Russell 2000 was down by 1.3. So what happened last week in the US, particularly with the NASDAQ, is not as good as it looks because this is something that I never like to see, and that's the breadth deteriorating sharply. So that is something I'll be watching very closely. But on the fundamental side, if we look at XLK, which is the overall technology index, there were 20 stocks in the XLK that reported last week. 20 out of 20 beat revenue estimates and 19 out of 20 beat on earnings estimates. So don't think that this rally in the US is about momentum and blindness to valuation. Now, I know that in America, they do play a bit of a game. Companies and analysts tend to lowball the estimates so that when companies beat them, then everybody's happy and the market goes ahead. But having said that, some of the forward expectations are pretty modest. And I think history would show that they're underdone, that a lot of the companies are easily beating their expectations. So that was the reality of earnings momentum last week in America. And if you look at the companies in XLK that have reported this quarter, 96% of XLK stocks have beaten earnings estimates. So the next time you read something about America is overvalued and this is close to a market peak and it has to crash and all this stuff, just try and remember some of these numbers, that this rally is not based on just expansion of multiples. It's not based on just momentum. This is based on real revenue and earnings growth. Now, that doesn't stop certain stocks getting short-term overvalued and then they correct back, but that's just a natural part of the cycles of the market. But to say that a significant part of the American market is overvalued and therefore must peak out and come back is just not correct. So we've got a nervous market, and this is what I really take from this and from decades of experience. When you've got strong earnings and revenue growth and you've got a nervous market purely on the basis that prices have advanced a long way, then that's a great opportunity for long-term investors. Now, it doesn't mean we can't get some short-term shakeouts, and I'll be surprised if we didn't. But from a long-term positioning point of view, this is the kind of market that can really deliver significant rewards because you end up climbing the wall of worry, if you like. So that's how I see the US market at the moment. The US dollar index rose almost back to 100. The 10-year yield was up a little bit. It had dipped under 4%, but it was back up to 4.08. The VIX took it all reasonably calmly, 17.4 at the end. So let's go and look at some American stock charts first. So we'll start with the NASDAQ. On a daily chart, you can see we had a little bit of a wobble on Thursday and Friday. Prior to that, it was all looking pretty good. But the trends are what they are. They're continuing on where we've got the very short-term moving averages, the 8-day, the 20-day, the 50-day, and then, of course, the 200. They're all lined up in the right order, and the price is above all of them, and that equals the definition of a really strong upward trend. And if you want to try and pick the top just because it feels like it should be the top, then I can tell you that your chances of success are significantly reduced. You go with what is until the market tells you that something else is changing, that the sellers are starting to gain control. And there is absolutely nothing in this chart that tells me that the sellers are gaining control. The only little concern that I have, as I said before, is that the breadth suddenly seemed to disappear towards the end of the week. Now, that's only very, very short term, so I need to see a lot more data on that, but that is certainly one to watch. Moving on to the semiconductor sector, a weekly chart, you can see gap up on Monday, traded right up during the week, came back a little bit on Friday, but that is still an enormously strong uptrend. And I'm just going to run through a couple of charts. First of all, we'll look at XLK. So this is the overall index for the technology sector. And that looks very much the same as the semiconductor index. It looks the same as the NASDAQ index, so great strength. But let's look under the hood a little bit at some of the major stocks that influence that. Now, this is NVIDIA, which has just gone over $5 trillion in market capitalization. If you look at the earnings estimates and the year-on-year growth and then the resulting PEs, I can't see, and I've been saying this for a long time, I can't see that NVIDIA is overvalued, yet that seems to be consensus thinking. And everybody nods and says, yeah, I agree, but let's look at the numbers. So into 2026, we're looking at 52% year-on-year growth and a PE of 45. Now, this is very, very broad brush stuff, and I do it a lot more detail than this, and particularly around the drivers of what the next 3 to 5 years will be. But just as a very simple, broad brush look at the valuation, there is nothing wrong with that valuation into 2026 at all, or into 2027. 46% year-on-year growth and a multiple of 30. Now, it drops down to 23% into 2028, but that is always the case because analysts are always far more conservative the further out you go in earnings estimates. But even if that is correct and the earnings drop back to 23, there's nothing wrong with a PE of 25 at all. So the next time someone wants to tell you that NVIDIA is overvalued, just remember these numbers. And if we look at the last 3 years, so this is the forward 3 years, and the outlook absolutely supports this in my view. But let's look at the last 3 years, 125%, and that's per annum over the last 3 years. So the past and the future outlook for earnings does not equate to a stock that's overvalued. Let's look at Amazon, which was another stock to report through the week. By the way, NVIDIA reports on November 19, so I'll be keenly watching that report. And almost all of the last 8 quarterly reports have beaten estimates, and some of them beaten estimates by a significant margin. Let's look at Amazon, that also reported 29% year on year for a 34 PE. That's kind of line ball, but it's okay. It's not overvalued. It's probably fully valued. Into 2026, analysts are saying 9%. Again, I think the outlook drivers suggest that 9% is far too conservative. I think it'll be much better than that. And a PE of 31, so that looks a bit overvalued. And then 22% into 2027 and a PE of 25, which is fine. And bearing in mind, over the last 3 years, the average has been 85% per annum. That's the compound annual growth rate over the last 3 years. Is that overvalued or not? I don't think so. And finally, if we look at, which I think Google is the pick of the stocks, which if you're looking at Meta, if you're looking at Amazon or Tesla or any of those stocks, so excluding NVIDIA, then Google would be my favoured stock. Into 2025, we're looking at 31% year on year and a PE of 26. That's absolutely fine from a valuation point of view. And that's just consistent with what we've seen over the last 3 years. Into 2026, again, some analyst conservatism, but the fundamentals just do not support this at all. I think analysts are still leaning too heavily on the concerns around antitrust cases and also the impact of AI on search. And I think both of those, the results from Google, which you can see on Thursday, a huge gap up, jumped up some 7-8%. I think those results really bring into question those concerns around the impact on search and the antitrust cases. And then into 2027, we're looking at 14%. Again, it's just not consistent with the facts. It's not consistent with history. So I don't see an issue with valuation at the top end of the American market. And yet so many analysts are using that as the reason why the US market has reached a point where you should be turning defensive. Don't see it at all. All right, Australian stocks now, the Aussie dollar just under 65. There's now, with the very hot CPI result that we got through the week, there's now a 7% chance, or less than 7% chance, so almost nil, of a rate cut on Melbourne Cup Day. So forget that one. Our index was down 1.5% for the week, and that CPI number really should put rates back in the box for some time, probably at least 6 months or so, but the next number is obviously critical. And a good slice of the reason why that CPI was as it is really a lot around the cost of energy. Now, there were some very specific large cap plunges that contributed to our index being down by that much. CSL was one of them, and certainly a big contributor, and also WiseTech Global. And those two stocks were down very, very heavily and are in strong downtrend. Yet, amazingly, they're still being recommended as stocks to buy. not for me. Materials sector was steady, energy was higher, and most of the other sectors struggled. Turning now to other commodities, copper was at 509. I think it peaked out about 517 during the week. And we've got this delicate balance between there is short-term caution about demand for economic reasons. Then we've got medium-term supply tightening for the reasons that I've been covering over the last month. Supply issues in a couple of different places in the world, in Indonesia and in South America. And then just the long-term bullishness, looking out 3 to 5 years, and the supply versus demand balance. So it's a very interesting position here for copper. Crude oil, just a tick under 61. We've got caution around demand due to worries about what's happening with global manufacturing and also a bit of economic weakness in China. So that's on the one side. On the other hand, we've got supply uncertainty, which tends to put upward pressure on the oil price in the Middle East, and also just because of where sanctions might land, particularly with respect to Russia. So that's commodities. There's the copper price chart. We're looking at quite a strong short and medium-term trend there. All this sudden rise and sudden plunge was around the proposed tariffs on copper that, of course, didn't materialise. Uranium also had a good week and is in strong uptrend since the middle of March, and we're now back up to about 83. So wrapping things up, it was a huge week of news, but really, when you think about it, nothing changed for investors who are focused on high probability growth. Nothing has changed at all that I can see. So ignore the news, ignore the consensus thinking, set your weightings according to the mega trends that are pretty much unstoppable, no matter what happens with tariffs and trade and geopolitics. There are some unstoppable mega trends out there that are propelling the stocks in those sectors, and they're highly unlikely to change. Next step, identify the best of the best in each sector. Why would you not want to own the best of the best? Now, you may not always be able to buy them at a price that you're comfortable with, so don't. Wait. Have a list that's bigger than the number of stocks that you want to manage. And therefore, that'll help you to not chase prices. So just because it's the best of the best doesn't mean it's a buy today. You might have to wait a month, 6 months to get a price that makes sense. And that's fine. I've waited sometimes 12 to 18 months for a particular stock to get the price that I was comfortable with. And then you just wait and buy the dips. And this formula, this process, it's really simple and it works really well. And then, of course, the most important thing, and the thing that investors tell me is the most difficult, where they struggle the most, and that's a clear exit process that just takes the emotion away. And again, there is a simple 3-step process that I use for exiting and communicate that to our members. So that's the final wrap up. Portfolio analyst this week coming is taking stock of what happened in October, looking at the events, looking at the market reactions, looking at stocks that have been analysed. It's an enormous learning opportunity. So if you're looking to upskill yourself in the market, then 2-week trial for $1 in Portfolio Analyst is a no-brainer in my view. All right, that's it. There's more information on the website, and there is my email address, and I'll be back with you next Sunday. Cheers.